Hey guys, and welcome back to Let's Talk Forex. Alison and Chris. This week we're talking about the top 3 ways to minimize risk in Forex trading, things you need to be aware of. Forex trading is risky, and this is a really important episode, I think, especially for a lot of beginner traders. As always, if you've got any questions, send them through to us at podcast@fxscouts.com or get in touch with us on social media. We're everywhere, Twitter, YouTube, Facebook, you name it and where you can find us. Thanks so much and enjoy this week's episode.
Chris, how are you doing today?
Yeah, pretty good, Alison. Can't complain. England won last night. They beat the Serbians 1-0. Wasn't exactly expiring, but you take what you can get. A win is a win. A win is a win. I can't complain at all. How are you doing?
Yeah, good. It feels like it's summer in Kenton.
Oh yeah. But isn't it supposed to be midwinter?
It's supposed to be midwinter, but we are having the most glorious weather. It is just amazing.
Oh, nice.
There is no. I mean, I think when we spoke, I told you about there was a tornado in KwaZulu-Natal, and we had a heavy weather system moving over the Eastern Cape. But it's just absolutely amazing. It was the storm before the calm.
Lovely. Yeah. That's good. So let me guess, you're out on the beach a lot.
Yep.
Of course you are.
And you
it's
too.
Fantastic.
You too, I heard.
I have, but yes. I've also been on the beach, getting quite sunburned actually this weekend. I forgot to put sun cream in my face.
Oh no!
I know, disaster. It's all right. I'll live.
Cool. Well, just before we get into it, I just wanted to talk about what we're doing for next week's episode before we get into this week's episode. And we're going to be doing something a little bit different. So we want you, the listener, to choose the topic for us. And the 3 topics we've selected are the top 5 trading mistakes. So we want you to choose between these 3 topics. Number 1, the top 5 trading mistakes. Number 2, how to pick a strategy that works for me. And number 3, a summary of the market movements so far for 2024. As we know, it's been quite a wild ride. Wasn't quite in the beginning, but it's worked its way up to a very wild ride in the last couple of months. So you can either choose between those 3 topics, or you can choose a topic, something that you want to hear about, something different. And if you do have another topic in mind, you can email it through to us at podcast@fxscouts.com. But this poll will also be available, will also be up on Facebook, and we'll pop a link to our Facebook profile in the show notes.
Yeah, that'll be great. Looking forward to it. Yeah, I'm interested to see what people want to go for. I mean, I obviously have my favorite. I'm not going to say what it is, but I don't want to bias anybody. But yeah, no, I'd be curious to see what people want to hear about. Yeah. And that'll be our last episode of this season, and we're going to be taking a short break after that. We're back in August.
Cool.
Yeah. So this week, we're going to talk a little bit about minimizing risk. So before we get into that, I mean, I'm sure a lot of people who've been listening to this, they know a bit about the Forex market. It's the biggest financial market in the world. It's about $7.5 trillion traded every day, which makes it by far the largest market in the world, much larger than any kind of stock market or commodities. And it's one of the most liquid markets as well, which means, especially if you're trading the major pairs, it's possible to buy or sell currency at any time. So yeah, it's huge, it's liquid, and this allows it to be used 24 hours a day, 5 days a week.
Yeah, and just because of the scale and liquidity, it's considered the easiest market to start trading. And, as we know, anyone with an internet connection and a internet connected device can start buying and selling currencies. But, with the ease of trading Forex comes a lot of risks, which is something we obviously deal with quite a lot in our industry.
It is. Yeah, it is. And Forex trading is about managing risk. I mean, that's what this is all about at the end of the day. And the biggest and most obvious risk associated with Forex trading is losing your funds. You're always, when you go into the market, you're always looking to make a profit, and looking to be successful. But the average Forex trader is likely to lose money. I'm sure everybody's seen the warnings on a lot of broker sites. 60 to 90% of traders lose money. And this depends on which Forex broker, obviously. But I mean, it's a really high amount. And there's a reason for that.
Yeah, I mean, it takes a very special type of person to make Forex trading work, but often it's the type that can follow certain rules, which is what we hope people take from this episode. And what we often find also is that a lot of people get lucky on their first few trades. I mean, I've heard this so many times. And this is despite not knowing what they're doing at all. But this tends to make them quite overconfident, and because of that, they overlook the risks that are involved, and they really don't understand, what the risks are in the first place. So in this podcast, we're going to look at 3 top reasons that traders lose money. And the first one is the risk of unpredictable market volatility. And one of the key characteristics of any financial market, whether it's Forex, stocks, commodities, indices, is the continuous change of asset prices. And this is known as volatility.
Yeah. And on one hand, look, volatility is the main reason why traders are profitable. It's what you want as a Forex trader. If prices were static or there was very little movement, there's no point in buying or selling, no point in getting involved. The whole point of trading is to buy a security or a Forex pair at a much lower price and sell it as the price increases, or vice versa, when you're short selling. And without the volatility that you see in the Forex market, this is just not possible.
But on the other hand, the change in asset prices can also make traders lose money. So they may buy an asset at a certain price and then expect to sell it later at a higher price. But the market can easily go against them and drop the price. And then this obviously makes it unprofitable to sell an asset at that point.
And the risks in Forex trading are even higher because you get really incredible volatility in the Forex market, especially so you get really high levels of volatility, because the losses experienced by traders, if you've got a long position, is going to be far greater than it would be in normal conditions. And Forex markets spike a lot. We talk about this a lot, especially around news events. Spiking volatility, is caused by, there's regular news events that are coming, but there's also geopolitical events or economic things, earthquakes, all kinds of stuff. And these can lead to really dramatic spikes in volatility. And this will have a huge impact on the market. So with this kind of volatility in Forex trading, it's really important to be careful about your position size and not to open too large trades. You want to keep your volume relatively low. So to counter the risks coming from increased volatility, it's a good idea to use volatility indicators, so you can spot the start of high volatility early on and then take measures before it affects your trading account. So the 2 main ways of countering high volatility that you see quite often is using the stop loss order, obviously, and then hedging is the other one.
Yeah, I like hedging, and a simple hedging strategy is to open a counter trading order in the opposite direction of your already established trade. And this way, no matter how volatile the markets are, you get to keep the progress you made earlier in the trade and then remain in an open position. Hedging is often temporary, and you can cancel it then when the threat is gone. So once your indicators indicate that volatility is now sort of slowing down. On the other hand, the main drawback, obviously, is that you have to pay additional fees, such as spreads and commissions, when you open another trade. The stop loss, of course, doesn't cost anything, but poses the open position once hit. So you sometimes might lose some of the potential profits that you could have gained. On that note, we're just going to take a short break, so we'll be back soon. Hey guys, hope you're enjoying the episode. If you're looking for more trading education, visit our website or FX Scout's YouTube channel. We have plenty of resources available. And if you're looking for a good Forex broker, go and check out our broker reviews on fxscouts.com.
Yeah, we provide an in-depth analysis of each broker, highlighting both their pros and cons. And you can always write to us as well. We're happy to answer any questions. You can get to us at podcast@fxscouts.com. And now let's get back to the episode. And we're back. So yeah, that was the first one, the first main risk. And then the second risk is the risk of using high leverage. This is something we talk about a lot, isn't it, Alison?
Yeah.
So the majority of Forex brokers offer leverage to their clients to make it easy for them to control larger position sizes. This is because the movements in the Forex market are very small. So in order to make a decent profit of it with a standard retail account, so $1,000 or $2,000 in your account, you're going to want leverage in order to make a decent profit. So, for instance, if you want to open a trade for 100,000 and the leverage was 1 to 200, you'd only need a 500 deposit instead of the full 100,000 US dollars.
Exactly. And it obviously goes without saying that an increased position also increases possible payouts. So, it can increase your profits. So if we look at the example you were just talking about, the payouts, a payout of 10 pips would be just 50 cents for a $500 position, whereas the $100,000 leverage position would generate $100. So it's a huge difference if you leverage your trades in terms of profits.
Yeah, exactly. And it's the reason why everybody does it. But unfortunately, leverage is a double-edged sword because it also increases the size of losses when you make them. So a 5 pip loss, for example, would cost you 25 cents if you just had a $500 trade. But if you'd use leverage of 1 to 200, you're going to lose $50 from that position. And in some cases, you may lose more than your initial deposit. And this is especially true if you're trading with an offshore broker that doesn't have negative balance protection. It's something we're very clear about, that always make sure your broker has got negative balance protection before you go, and especially if you're a beginner and you're just starting out.
Yeah, it's something we actually write about quite extensively in our broker reviews. So in all our reviews, you'll get to see whether the broker offers negative balance protection or not in your particular region. And to counter the risks of using high leverage, then you need to be disciplined. Kind of goes without saying. So often when traders lose money, they get the desire to recover those losses right away, and then they fall into the trap of revenge trading. So it's very important to have clear rules about position sizing and never risking more than what's determined pre-trade. So have a amount that you're willing to risk, and don't go back and try and recover that after the fact. And you also need to keep in mind that there's another effective way to limit leverage risks. You can simply select a lower leverage during the account opening process. So you may start with a leverage of 10 to 1 or 20 to 1 initially, and then increase it as you test and refine your trading strategy. I often find that's a very good way for especially beginner traders to start trading is just reduce your leverage size and reduce your position size as well. It's something we spoke about in our podcast with Caroline and from Trading Angel and Neil Bateman from Trading Angel. They both said their biggest piece of advice would be to reduce your position size.
Yeah, and Tom Salmon at SpreadX as well. Yeah. He said the same thing.
Yes, true.
Keep your lot size small. The third main risk to do trading is having your positions closed unexpectedly. This will obviously result in you losing money quite often. You need a certain amount of money in your account to keep your trades open, and this is known as the margin. And if your account balance doesn't cover the broker's margin requirements, you may experience something called a margin call, where the broker closes your positions for you. It's almost like having the stop loss in place where when your account gets to a certain percent of capital. Most brokers will have a margin call of 50%. So now even if you've opened a position anticipating it to go in a certain direction, if the market goes against you, margin call may occur, and this will mean automatic deduction. Automatically, your trade will be closed at a loss, and that will obviously result in a loss of your money.
Yeah, so to prevent this from happening, you want to ensure that your balance is always visible. It seems obvious, but not all traders trade like that. You need to have your balances visible, and you need to work out at which point a margin call may occur. And then at that point, you may want to add more funds if you're confident in your analysis that the market will go in your desired direction. And you also may want to set alerts and stop losses to ensure that you protect your fund before a margin call occurs.
Yes. Yeah, no, there are handy ways to avoid it. But I mean, hopefully you won't hit the margin call anyway, because you would have a stop loss in place.
Exactly.
That's going to prevent you from getting there in the first place.
Yeah. And so, also because you'd hate to risk 50% of your capital if the margin call got 50%.
Exactly.
You'd want a stop loss in place at the between 2 and 5% sort of level.
Yeah, exactly. But yeah, those are I think the three main risks.
Yeah.
So yeah, I think that's for next week. Topic, as we said, you're going to let us choose. Sorry, you're going to choose for us, which is going to be exciting. And then, as I said, we're off on holidays, aren't we, Alison?
Yeah, we are. Well, I'll be off a little bit from our winter and your summer.
Yeah, super. Cool. Well, I look forward to seeing what the audience has chosen for us, Alison. It's exciting.
Yeah, me too.
I'll speak to you next week.
Cool. Cheers, Chris.
Cheers then. Bye.
Bye.